Okay, fine then. So we go on with something which is not related to what we saw in the last 2 seconds. This is now the optimal investment with crashes and unhedgeable risks. I'm not sure about the unhedgeable risks, but I'm sure about the crashes. So usually when people tell you about weaknesses of Black-Scholes model, they say, well, we know it cannot explain the large price movements, especially the large down movements. And so we introduce some more fancy processes. And this is of course perfectly okay, but the point is, in the Black-Scholes model we already have the problem that we can hardly estimate the drift parameter. We can easily estimate the variance parameter, but if you have jumps inside, then it's very hard to estimate the jump intensity, the mean jump height and other things, because they are rare events, so it's not easy to estimate them anyway. And therefore, Philip Hua and Paul Wilmot, they came up in '97 with a so-called non-probabilistic crash modeling. It's always a bit annoying for me as a probabilist to be part of that, but the idea is, they said, we assume that the number and the size of crashes in a given time interval are bounded. Like, there will be at most one crash until Christmas. It will not be bigger than 20%. The whole market will not go bigger than 20%. It might be 5%, it might be 1%. There might be no crash at all until Christmas. So upper bounds instead of probabilistic assumptions on height, number, and times of occurrence of crashes. This is one ingredient. The second ingredient is, in a paper by Paul Wilmot and myself, we tried to determine worst case bounds for the performance of optimal investment. And I will show you first the first ingredient, then the second one. We'll try to highlight how we get there, and we'll then show you what the consequence of this is. Okay, I'm trying to use the most basic model in that setting. I'm assuming we have one bond and one stock. We have at most one crash between 0 and t, at most one. There might be one, not more, but there might be no one. With a maximal height of k star, and k star is the relative size of the crash, which means that in normal times, bonds and stocks behave like Black-Scholes model, and then at the crash time, the stock price falls by a factor k, which is inside that interval. Both k and the crash time, they are actually random variables, right? We don't know them before, they are uncertain, and that's it. Now, oops. There is a very simple consequence of this thing. You want to relate your wells before the crash time and afterwards, and that's really trivial, but it's crucial. Just before the crash time, and I assume that my portfolio process is left continuous. Just before the crash time, I had invested that amount of money in the stock and the remaining money in the bond. Now, if the crash happens at that time, my amount of money in the bond stays the same, it has not changed. But my amount of money in the stock is only worth 1 minus k times the amount it was before, because I've lost a fraction of k. Now that's pretty easy. Yeah? You take the x out, you've got 1 minus pi t times k, and you've got your new wells afterwards. So that's the relation of wells before the crash, wells afterwards the crash, and this is multiplied by a factor 1 minus crash height times the amount or the fraction of your wells that was invested into the stock. That's nearly trivial. There's not a lot to say, but this is a crucial relation, because if I'm looking at the final wells then, my final wells, if I'm following a portfolio process pi, looks like that. You have this here, the evolution in the crash-free setting, and this is multiplied by that crash effect at time t with the size of k. So you have a very clean separation between crash effect and trading effect. And to make this more precise, it means that if you're following a high pi, then this in tendency will be big, but of course the loss if a crash occurs will also be big. If you're following a low pi, then this will be small in tendency, but you don't lose a lot of money if a crash occurs, and if you're negative, you even make a gain, right? So you have two effects high is good if no crash happens, low is good if a crash happens. And of course, you have this typical aspect in finance, two competing aspects. You have a balance problem between the risk, the crash risk here, and the return which is given in that investment in the crash-free setting. This is what we have to look at. Okay, now, what I always told you is, if you're investing, try to set up such a problem and try to solve this problem. Yeah? Try to solve the problem, find the optimal portfolio problem that maximizes the expected utility from final wealth, which now has this representation, but I cannot solve this problem because I don't have the full probabilistic information. I've got no idea about the distribution of the crash time, I got no idea about the distribution of the crash height, and therefore I cannot solve this problem, but I can solve the problem if I put in the infimum here. So I'm trying to make this worst case bound as good as possible. The market is allowed to choose whatever kind of crash time or crash height, and I'm then trying to make this the expected utility over this infimum. I'm trying to make this as big as possible. That is my second ingredient. It's the worst case bound that I'm trying to maximize. Now, I will illustrate this with two very simple strategies in a moment. Before that, there are two remarks. First of all, I make this assumption that the mean rate of stock return is bigger than the interest rate. Well, you would say we always assume that, right? At least implicitly. But here it's quite crucial because this assumption allows me that I can always dominate strategies which attain negative values. I can always dominate them easily with respect to the worst case bound. Therefore, I can restrict myself to portfolio processes which are non-negative. This is something I have to prove. I don't do that here. The second thing is, if I have two strategies and I compare them, usually they don't have the same worst case scenario. Usually the worst case thing for them differs, and I only compare the worst case bound. If one strategy would always be better than the other one, that would be an arbitrage opportunity anyway. So they are not omega-wise better, they are only better with respect to the worst case bound. And to understand that a bit better, I look at two different simple strategies. The first one is the playing safe strategy. That says, well, I don't invest into stocks because I know a crash might happen until Christmas. Then I tell you that the worst case scenario is that of no crash, and that leads to that worst case bound. First of all, we need two things. We need the value function in the logarithmic setting. This is what I'm writing up here. So V0 t comma x. This is the supremum over all pi restricted to t comma t. Expectation t comma x ln x pi t, and I say tilde, which means I'm in the crash-free setting. From all what I've learned this morning, I can write that down because I know that this is the B star we had. This is ln x plus r plus 1/2 theta squared, or b minus r divided by sigma squared times t minus t. That's the first thing. The second thing is, before I really use this, well, it's a question to the audience. Is a crash good or bad? Seems to be an easy question, right? And there is an easy answer. And this is the answer that is always correct. No. Here it doesn't matter. No, it matters. No, the answer is it depends, right? If you have invested your money in a stock and a crash happens, you lose a lot. Now here, if you don't have invested money in the stock, you think it doesn't matter. That's not true.
Not for that trading strategy. I mean,
no, that's not true, Christian, because remember, we're in the model, we're not in the real world. In the model, it's clear what to do if the crash has happened. You switch, after the crash, you switch to the optimal strategy, pi star, say 0, which is the optimal strategy after the crash has happened. This is b minus r divided by sigma squared. This is what we learned, right? So if the crash happens, you can directly switch to that strategy, make more expected utility, and you don't lose here. So the worst thing for you is no crash happening, because then you can never switch. If the crash has happened, it's good for you, you haven't lost, and you know the danger is gone. So therefore, this is really the worst case. The worst case for that guy is no crash at all. Has to wait until the end for the better situation. It doesn't come. Well, he ends up with that, and that's his worst case bound. Now the second guy is the one who invests as if someone has told him, well, there will be a crash, maybe, but he says, well, don't care about it anyway. I do the same thing as before. I take this b minus r over sigma squared. Now for him it's clear what the worst case scenario is. It's a crash of maximum height k star, of course at any arbitrary time between now and the end, because afterwards, so I'm losing money and afterwards I'm switching to the same strategy again. Now what happens for this guy, if it's at any time, we can make this at the beginning, and then this x that we have, if there is a crash, remember, the x goes over to x times 1 minus pi times k star, and at this time here the pi is 1 minus, we have it here, b minus r over sigma squared times k star. Oh well, I didn't write the pi star out anyway. So what you have is, you plug in this into that x, because that was the immediate crash, and then you see, you get this here, the ln x, plus this ln term, and the rest remains the same. Now if you compare both, this term is exactly the worst case bound for that. So we only have to look if this is positive or not. Now there's a t inside, so if the time horizon is really far away, then this is definitely positive. Now if the t is small, this is definitely negative, because this is positive, 1 minus that, so this is negative. If the t is small, that term is negative. So it actually depends on how far we are away from the time horizon, which one of the two is better, this one or that one. So here are some insights from that. First of all, that's what I already said, it depends on time to maturity, which of the two is better. But the consequence is, a constant portfolio process cannot be the optimal one. Because if a constant portfolio process would be the optimal one, it would be this one. But this is sometimes even worse than the playing safe strategy. This thing here is not risky enough if no crash happens. This is too risky if a crash happens. And there's always a bad thing about it. If you can directly identify what's the worst case, then you always have the feeling you can make the strategy better. Yeah? So here it's, I know the worst case is no crash happening. I'm losing money. So I'm trying to be a little bit more risky. If I'm a little bit more risky, maybe a crash is bad for me, but maybe no crash is as bad for me. Yeah? Because I cannot switch to this very good strategy. And it's like looking for an equilibrium, that you have a point where you cannot decide, you will be indifferent between a crash happening now and no crash happening at all. Maybe this is something where you cannot make the strategy better, making this more risky or making this less risky. If you make the corresponding strategy less risky, you lose. If you make the other one even more risky, you will also lose. So my idea first was, I'm trying to look at the so-called indifference strategy. And let me also give you an idea how I tried to come up with that. So the indifference strategy. My idea was have a strategy pi hat, and with the strategy pi hat, there is on one hand an immediate crash. And the worst thing of this immediate crash is if it's of height k star. And then I know I'm making that utility v0 t, comma, x times 1 minus pi hat of t times k star, right? And from this, I know this is ln of x plus r plus 1/2 b minus r over sigma squared times t minus t. And then there's this plus ln 1 minus, where there is the pi hat of t times k star. Okay, on the other hand, I want to be indifferent between the immediate crash and no crash until the final time. So the indifference approach says this should be equal. And if I do that, well, what do I get then? Then I get the expected utility starting at time t comma x, ln x pi hat of t, and now with a tilde because there is no crash at all. And what I can do is I can use Ito's formula for that. And I can hope that the dw term cancels out and so on. So I have an ln of x at time t. Then I've got an expectation of the integral from t to capital T. Then I got the derivative of this, which is 1 over x, which is nice, which cancels out against the dx. So I have a r plus pi hat of s. Well, I've got the 1 situation, b minus r. And then I got the second derivative, which is 1 over x squared, but with a minus sign, so minus 1/2 pi hat of s squared times sigma squared. That's my ds term, plus some term with dws. And the nice thing now is that pi hat is something that I can show, or can I assume that it is bounded and non-negative. Therefore, this expectation of this dw thing, this I assume to be 0. So, what I end up with is the following. I end up with terms here which are on the right side and on the left side. There's also a way. And then I have this term here, I have this term, and I have an integral. And what I'm actually doing is, I'm taking the derivative d of dt on both sides. Then this here is a constant. This is 1 over this multiplied with pi hat prime. And here the integral goes away. I've got this, this, and this with a minus sign. And I get a differential equation. Well, forget about this. I get a differential equation for my indifference strategy. So this differential equation looks a bit complicated because it has pi in quadratic and in cubic terms here, but you can solve this explicitly up to a constant. Yeah, the form is not very nice, but you can solve it explicitly up to a constant. I can show uniqueness, I can show it's bounded, and my indifference strategy at the end, my indifference requirement, that requests that I end up with pi of t being equal to 0. Why that? At the end, I cannot compensate for anything, but I might make a big loss if my pi is still positive. So at the end, pi hat of t must be 0. So if it solves this, then I'm indifferent, which I just derived here. And even more, what I can also show is that this strategy yields the highest worst case bound. This is nothing that I can explain in 5 minutes on the board. This is a longer proof. But you can show that it yields the highest worst case bound, and I'm indifferent between a crash of maximum size happening at any future time or no crash happening at all. And after the crash, this is the optimal strategy anyway. So in the log utility setting, I can give this quite explicitly. And I skipped the 2 theorems on the page before, because those 2 theorems, they look mathematically nice, but if you look inside, you will see that this is the only example that you can compute with those 2 theorems before. Okay, let me show you how the optimal strategy looks like. This is the optimal strategy with just one crash, at most one crash. You start here, this is my solution of the differential equation. You start here with approximately 25%, you reduce, you reduce, you reduce, your crash has not yet happened, and you reduce to 0 until the end. This is quite remarkable because that's a typical behavior. If you have a time limit, you always told reduce the risk if you're close to the time limit, like if you're investing for your pension, you should reduce your risk when you're close to retirement. However, if the crash happens at that time, then I know no more crash, and then I jump up to the model in the crash-free setting, and that's it. So such a strategy is always a two-part strategy. Yeah? But the nice thing really is, and this is what a lot of other strategies cannot explain, you're actually reducing this if you're still under the threat of a crash until the end. Okay, that's one thing.
And Ralf,
Yep.
that is the only solution for...
That is the only solution.
Because somehow it appears to me intuitively, like when I come close to maturity, maybe I would invest a little bit into...
Okay,
But
let me explain what you are thinking. You are thinking in terms of a Poisson process. This is more like the intensity of one crash per year.
Yeah.
Then you say, okay, that's one crash per half a year, so the intensity gets higher, I have to reduce, and then the intensity gets close to infinity, right? That is like Poisson people would think, but the worst thing is at most one crash. If you're going negative, you're losing with respect to the expected utility if it doesn't happen, and you're depending on the crash. You could say, of course, here, at the final time I go to minus infinity and hope if a crash would happen. First of all, I said the strategy must be left continuous. That, of course, excludes that. On the other hand, well, the stock doesn't care about your strategy. So there is no increase in the jump intensity anyway. It's just the danger for you. And as this negative thing would make it worse for you, you could bet on the crash, of course, and hope for a big deal and make only a tiny loss with respect to utility, expected utility, but it's the worst case situation. The worst case situation then would be no crash at all, and then you would be dominated by that strategy. Okay, here is the situation if I have 10 years to go. If I have 10 years to go, even that optimal constant before and afterwards would be above that, and it's clear. A crash is no big threat here because then you know, okay, I lose a lot, but then I have a long time to make up for that. And it's the same if you're indifferent, you're in here. And only here, this last part, this is what we saw in the picture before, but there the blue one was 0. Okay, there are a lot of modifications to make here. And a lot of modifications to make are, first of all, what happens if you have more than one crash? If you have more than one crash, your optimal strategy looks like this. Here's the one, the pi 0 star. Here is the one if there is at most one crash. Here is the one if there is at most 2 crashes. And it goes on like that, being a bit more flatter. Yeah, and on like this. And the nice thing is, what you get there is, you start here, the crash happens, you go up, 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 and up again. And what you get is you get a system of differential equations, but you can solve one after the other explicitly. Therefore, I can produce those lines. They are only weakly coupled. That's more than one crash. If you have multiple assets, then things get more numerical and you don't have it so explicitly. If you have insurance risk, so if you have an income stream which is uncertain and you cannot hedge it, yeah?
Are the lines for the more crash models, are they still concave?
No.
Why not?
Well, I think, you see, I really draw this on purpose,
yeah.
Right? Because if you're here, imagine if there are the threat of the crash gets more pronounced, and still 4 crashes, and still 4 possible crashes, and then you should not, and you have only a very tiny time to compensate for that.
Yeah.
Yeah, and then you should be more risk averse than that. So there is no reason for them to be concave.
But the first one is okay.
I'm not even sure about that.
Ah,
I'm not even sure about that. It says concave in my pictures.
yes.
Right? I should maybe try out some more extreme examples with K star being big. I don't know it. I've never qualitatively looked at those. But it's a good question. Okay, so if there is insurance risk, if there is something that you cannot hedge, then you cannot use the logarithm, you cannot use the Harrow utility function. What you're then doing is what the insurance guys are doing. They are using the exponential utility function, which is no utility function in the sense of what we introduced this morning. But that's only for mathematical convenience that we introduced this morning utility functions with an infinite slope in 0. You can still solve that, and there is another aspect which I find quite nice, and this is the aspect that, no, this is not yet the aspect. This is only the aspect that comes in if you have changing market coefficients after a crash. So far, my model is there might be a crash, then the crash happens and everyone forgets about it. Yeah, it's the same situation afterwards as before. Now, usually if a crash happens, at least the market price of risk changes, because the crash might be quite bad and the situation might be really discouraging afterwards, or people have expected a crash for a long time because they said we're in a bubble and this cannot go on like that. Then the crash is something like a relief. You're very much down and you have the feeling that afterwards investment situation is much better. Now, if afterwards is much better, then you can run into the following example. You could have something like this. There's the T, there's the indifference strategy, pi head of T, and there is the optimal strategy. But which optimal one? Well, if I jump into this new market. Yeah? So the new market is the one with the pi 1 star. I call it just pi 1 because that's the market after one crash. And if the new market is better than the old one might have been here. Pi 0 star. Now, what does that mean? It means in the old market, this was the optimal investment in the crash resetting. Now, if you want to be indifferent between a crash and no crash happening at all, then the indifference principle says you be here. But there's no reason to be here. Because if you're there, you're losing on expected utility compared to the green strategy. And if there is a crash, you lose more money because you're invested much stronger in the stock than there. Therefore, the optimal, not the indifferent strategy, the optimal strategy is follow the green line until it is still lower than the indifference one, and then go to there. Yeah? So the point really is, if a crash is something like a relief, then I'm not indifferent anymore. Then it's much better to hope for the crash until you're on that side of the indifference strategy. From here on, indifference is optimal, but otherwise, this is the case. Yeah? You can really identify what's a better situation. A crash is better than no crash and being indifferent. Therefore, this argument breaks down at that time. So this is something that is inside this here, or inside this joint work with Ralf, who will talk about that when he comes here. Another thing is, in the general utility function case, not in the logarithmic case, this indifference argument doesn't really help me because I can only compute the optimal strategy among the deterministic ones. And I'm interested about the optimal ones. And therefore, together with Mount Stephenson, we tried to find a Bellman equation analog in that situation. But that is quite hard to find. And in fact, you don't get an HJB equation like we had this morning. You get a system of two inequalities and a complementarity condition. And I think it's pretty hard to solve these kind of things explicitly, but we already had 3 examples where we knew the optimal solutions and we could solve this equation there and get out that for a general utility function it's still optimal and not optimal among the deterministic ones. Then you could have crash hedging and worst case control. That is something Olaf Menkens will speak about I think, when he's here. Okay, I think that's what I wanted to say. That's a good point. Open problems, use of options. If I'm afraid of a crash, why should I fiddle around with all those strange systems? Why shouldn't I just buy a put option, right? If then things go down, I get the money back, otherwise I don't get it back. Nice idea, wrong question. Why is it the wrong question? Well, the correct question would, or the situation is the following. If a lot of people are expecting a crash, then put options are expensive. So the correct question would be, what is the right price of a put option in that setting? Yeah? How do we price a put option if we are afraid of a market crash and if we don't have probabilistic assumptions about that? It's not easy, because the question about equivalent martingale measures is not easy at all. You have this non-probabilistic, this infimum stuff inside. So that is a very interesting question, how to value options in that setting.
But you could do the utility indifference pricing. Did someone try that?
Well, you could, but you can't solve the indifference problem. There's this infimum stuff inside. If you do the utility indifference pricing with this infimum operator inside, that might be an idea. Yeah, because it's not the utility problem that you can solve because you don't have the full probabilistic information.
Yeah, but with the worst case approach.
With the worst case thing, you could try that. That's right. Right? And then still there's the question of the interpretation. What's the outcome? There are other things like including consumption. This is surprisingly hard. Yeah? It's not clear if you could consume as long as you have, or you should save after the crash. It's not clear. And of course, I think this kind of approach could be applied to the control of social or technical systems whenever there is something like a possible catastrophe that you are aware of, but that you cannot model because it occurs so rarely that you don't have the slightest idea about probabilistic information. Okay, my last thing for today, obvious, is the optimal investment with transaction costs. With transaction costs, if you go to the literature, whoops, here we are, there are typically three approaches. One is the approach that includes fixed cost components that was initiated by Mark Davis and Norman in 1990. They have proportional transaction costs, and what they come up with is they say, okay, if the Merton setting is have a constant portfolio process, then this says, okay, we also want to have a constant portfolio process, but we cannot keep it constant, that's too costly. We do the following thing. We look at that, the amount of money invested in the stock. I'm not sure if it's that way around, but it makes no sense either. And the amount of money invested in the bond. Now, constant portfolio means this is on a straight line. This is what they call the Merton line. And I'm not sure about the exact slope, but it's only an illustration. And they say, okay, keeping things on the Merton line means you are eaten up by transaction costs. So what they come up with is they have something like a wedge, and they say, okay, we let this just move around here. No, it's not possible to move like that. We let this move around here in this direction, and if it hits this, then we just do the minimal action that prevents this process from going outside. Yeah, just a kind of reflection here, or whatever, from going outside. So they say, do the minimal possible action. This is quite nice, but the result is it's a problem of singular stochastic control. They can solve it, but the optimal strategy is do an infinitesimal transaction here, an infinitesimal one. Maybe do it quite often if you're in the neighborhood, but that's again something that is not practical at the real stock exchange. If you have fixed and proportional transaction costs, then you never do an infinitesimal transaction because you have to pay a real amount. Here it's an infinitesimal amount. Then you always do something real. It's like if you have a constant portfolio or constant strategy here, then you got these things, if this is phi star, then multiplied with P1 of t. If it goes like this, if it hits this boundary, then you go to the inside, to the optimal restarting point. Or if it's here, you have to increase this by buying. Then it says go up to there again, and so on. Yeah. This is very realistic, but you have nearly no chance to solve this. This leads to problems of impulse control, and you don't have chance of solving problems of impulse control which have a bigger dimension than 1. There is a third approach by Morton and Pliska, which I call nonsensical transaction costs. Why that? Because that's quite hard. Well, Morton and Pliska say, if you're doing a transaction, you have to pay a fixed fraction of your wealth. Why is that nonsensical? Imagine you have billions of pounds invested in your shares, and then you have the idea of saying, oh, there's a new company, I just want to buy 10 shares of this company. Then your broker says, oh, that's nice, by the way, you've got billions of pounds invested, you know that this costs you 1% of your total wealth, right? So the guy has to pay millions of pounds for just buying for 10,000 pounds shares. On the other way, if you are doing that, if you want to buy the whole Microsoft company, it says, oh, that costs you just 100 pounds of transaction costs because you don't have that much. That's also nonsense. The idea of course, of having this proportional to your wealth is that allows you to make a nice analytic solution. That's the point. It's the problem. So it's a real academic approach. I'm trying to adapt the problem in such a way that I can solve it. Okay, why do I look at the third one? The point is, the other two are non-solvable, the third one is solvable. And the funny thing is, I can show you a modification that adapts it to the real life. So that's their approach, fixed transaction costs, and they say, okay, let the portfolio evolve freely, and if it's on that boundary, this is what they derived. They derived a boundary which looks like an ellipsoid. If you're there, then transact to its center again, to the inside, pay that amount of transaction costs. Now, this is still a very complicated problem to solve. So that's the mathematics behind it. Forget about that. The idea is the following. There is an approach by Atkinson and Wilmot, and they said, well, we assume that this epsilon is a small parameter. If this epsilon is a small parameter, then they do what is called an asymptotic analysis. They always look for the right order, the right scaling that they have to get an approximate solution. And what they did is they showed that if we take the Merton point as the center of an ellipsoid, and if this ellipsoid, see here, is characterized by a matrix M, and then this ellipsoid has a radius of epsilon to the power 1 over 4, and if this matrix M solves this matrix equation here, this is just a deterministic matrix equation, which has a unique positive solution. If I can solve that, then I can set up this continuation region here, and then I get the asymptotic growth rate here. So what they're actually doing is, they are looking for an ellipsoid. That Merton thing, well, that Morton-Pliska thing was an ellipsoid, but Atkinson and Wilmot, they are looking for an ellipsoid in dimension 2. Here's the Merton point, and maybe the ellipsoid looks like that. Nearly perfect, not exactly. And then they say, we try to keep our optimal portfolio. Here's component pi 1, here's pi 2. So we get two assets, one stock. We keep it inside, and as soon as it touches the boundary, we transact back to the Morton point, Morton-Pliska point. Okay, the nice thing is, you can solve this matrix equation for whichever dimension you would like to have it. Yeah, it's a bit of programming. What you're doing is, you're looking for the eigenvalues of sigma transpose, and then you're looking for the eigenvectors, and then with the help of those, you can solve this equation on the left-hand side. Yeah, and if it's in dimension 1, it's just a quadratic equation, so that's easy to solve. Okay, you can solve it, and then all your work is done. And then they even tell you here, we can get an asymptotic expression for the growth rate. Yeah? What you're subtracting here is a minus 2 to the square root of epsilon. So you have the impact of transaction costs to the growth rate. This would be the optimal one without transaction costs. And this is the impact here. And you can see, you can even judge this. Judge the effect of the transaction costs to the growth rate. This is nice, as we could solve it. But still, the structure of the transaction costs makes no sense, right? Only if you could solve a problem, it will not get more realistic. And I don't know what my motivation was. But at some point, I had the following idea. The following idea was, can I compare the real-world transaction costs, those which are actually occurring if I would follow that strategy, because the strategy looks quite nice. Yeah? Let the process evolve some time, and if it is far away from the optimum, transact back to the optimum and restart again. That looks reasonable. That is something that I would really advertise on. And then I try to compare those things. And then I get the following idea. First of all, what I looked at is I wanted to estimate the transaction costs, the real ones that occur. And what I have to do then is, well, what is the biggest possible transaction, and not with respect to the L2 norm, it's with respect to the L1 norm, because it is transacted volume multiplied with the proportional costs, and that is summed up. So I'm looking for that vector that is on that ellipsoid, but that has the biggest norm if I'm adding up the absolute values of the components. If I'm doing that, then I know that this guarantees the highest possible transaction costs. And then I'm trying to estimate the actual transaction costs. The actual transaction costs are easy. This is what I have before the transaction minus what I have after the transaction. Yeah, this is smaller because I've made a transaction. I didn't gain something, but I had to pay transaction costs. They can be estimated by my wells afterwards times the norm of that, of y star, times the norm of this, times k star, and k star is k over 1 minus k transaction costs over 1 minus transaction costs, multiplied with epsilon to the 1/4. This is just 2 or 3 lines, this is not complicated. But this is what? This is k tilde times epsilon to the power 1/4 x of t. Now what is k tilde? K tilde is just this. Okay. I can estimate the transaction costs well, but do I really know that the transaction costs I have to pay in the real world are bigger than the transaction costs I have to pay in the Morton-Pliska strategy? Well, here's the point. If I'm choosing, let me just think about one thing. I think there must be a minus here in both. I'm not pretty sure about that, but maybe. If you have a minus here, you're definitely on the right-hand side because xt minus is bigger than xt. I think there's a minus here. Okay, in particular, if I take the epsilon is just an artificial parameter. I still have it at hand. The epsilon doesn't exist, the k does exist, and therefore the k star does exist. If I take the epsilon star equal to k tilde over 4 to the power 4 over 3, what happens then? Then I have an epsilon which is k tilde to the power 4 over 3. So it is k tilde multiplied times k tilde 1 over 3. So this again is k tilde 4 over 3. So this is the epsilon star again. But the epsilon star times xt minus, these are the Morton-Pliska costs. Right? So for this epsilon star, I have estimated the actual transaction costs, so there must be a minus here and there. I have estimated the actual transaction costs by the Morton-Pliska costs. Yeah? So in this model, where I had the epsilon at my disposal, and I had realistic input, I could show that if I'm following that strategy, I'm on the good side. In real world, my transaction costs are smaller, which means that in real world, my return is bigger, right? My return is bigger, my actual growth rate. So what I have is, in particular, I can now compare stock investment with pure bond investment, and that is only better if that inequality is satisfied. Now, what I claim is, I don't have an optimal strategy. I don't claim optimality. I claim that if I follow this Morton-Blisker strategy, I can show that my transaction costs in the real world are lower than the Morton-Blisker costs, and therefore my return is higher. So I think I can suggest a good strategy, a practicable strategy, that can be used for shares, for 100 shares, 200 shares, or whatever. And I have to compare this strategy then to the performance of other strategies. And here is a guide to applying that. I first determine my matrix M by solving the matrix equation. Then I check if it still makes sense to invest, if the transaction costs are sufficiently small. And sufficiently small means if this thing here is satisfied. This is easy to check. If I have done that, then I simply follow the Morton-Blisker strategy. And here is an example. If my transaction costs are 0.1%, then the growth rate is nearly the same as if there would be nothing. And then my interval, my ellipsoid is then just an interval, has a length of 16%. If the transaction costs go up to 1%, the interval length gets bigger. If it goes up to 5%, it gets bigger and bigger. And here, you see the interval length is so big that I leave the positive area, which is not okay then. On the other hand, it's 10%, and for 10%, the asymptotic expansion is maybe doubtful. For here, it's okay. But what you see is something that is well known. If transaction costs increase, the interval where you don't trade, this ellipsoid gets larger and larger, and you don't trade very often. And what you also know is, if you're close to the optimum, then the loss in the growth rate that you get is not that big. That is also something that is common sense. If you start close to the optimum, and if you don't follow the optimum strategy, if you don't do a lot, you don't lose a lot. Okay, here's a two-dimensional example. Again, you see you lose something. These are the 6%. And you see if you have 1% transaction costs, you lose a lot compared to that, but not that much, because the pure bond investment only gives you 5%. Okay, so we can sum up here. What we have done there is we started with a nonsensical setting that has a reasonable trading strategy. And now we obtained a reasonable strategy. We obtained upper bounds for the costs, lower bounds for the performance, and we only have to solve a matrix equation. So this is really a practical problem that we solved, and we adapted this nonsensical approach in one hand, and of course this is applicable. This is now not suffering under the curse of dimensionality. There are some open questions like, what happens if I include a fixed cost component? This is not so easy because there is no fixed cost component in the Morton-Blisker problem. There are other things like how good is the approximation, how good is the accuracy of the approximation, and so on. But on the other hand, this is a typical way of an industry solution that you can use that is not optimal in a mathematical sense, but that is reasonable. So that is something else when you want to apply those things. Optimality in the theoretical way often doesn't fit with the assumptions that the industry makes, like no trading at all time instance, or positive transaction costs, or whatever. But this is something that goes well with all the assumptions that the industry has, besides the fixed cost component. Okay, I think, as already estimated, there is no time for the optimal investment with the stochastic interest rate, but that is quite technical either, and you have the last slides for that. So here is a good point to stop. Thank you for your attention, and if there are questions, simply ask.
Maybe I have a question. When you compare your strategy in that case with other strategies, and you compare the transaction cost. What model do you assume? Do you assume, or do you artificially simulate stock prices with, or do you use empirical stock prices?
Here the only comparison I have made is just what happens if I'm just investing in the bond.
Okay.
Right? Compare to that. Yeah. Then you could also compare to what happens if you invest all your money in the stock. So with simple strategies where you can do something. What you could of course do is here, this is still limited to Black-Scholes type model. What you could try to do is you could use this kind of strategy and try to compare it with a stochastic volatility model or whatever and see what's the outcome here.
Yeah.
But then I don't have a bound anymore.
Yeah. Yeah, but no, my suggestion would simply be you have the strategy and you have stock price in the Financial Times or elsewhere. And if you would simply apply that strategy to the prices that are quoted, then you're completely out of the question of any critique with regards to the underlying model. And so if you could show there that the transaction costs are significantly reduced and the strategy performs better than any other strategy traders are using, you put yourself out of the critique.
No, that's right. No, that's really an interesting thing, I think. So this has never been tested empirically, but it's a good point. Because, as I said, this is a strategy that someone would intuitively do. Have something which is optimal, and let the whole thing run a little bit, and if it's far away from the optimum, transact back to the optimum. Right? This is intuitive, and therefore I think that's quite a reasonable strategy. And as I said, if you want to compare it to other kind of strategies like those that transact every day or whatever, that would be quite interesting. Okay.
Good.
We're already 7 minutes over time, so that's fine.
We should stop.
Thank you.